Everybody, welcome to another edition of Tuesday Talks with Ashley Hannah and Angelo Datseris, your Charlotte metro area real estate duo. I do the real estate and brokerage side, and my partner, Angelo Datseris, is in charge of all things money. He just hopped on, so we are ready to get started today. As always, please feel free to, that's fine. That's fine.
I'm thirsty.
Just staying hydrated. Yeah.
I'm thirsty.
Yeah.
Bet you didn't expect to see that, did you?
No, I don't even know what I was saying. What are we even doing?
I hate going to the water fountain at the office, so I carry this around now.
I mean, I'm surprised y'all have a water fountain that y'all can go to at the office.
I know,
like,
right?
Most water fountains have like tape over them right now.
Right. Yeah, we're lucky enough to go to there, but I don't go to there because, I just bring my gallon jug with me.
Right,
I mean,
that's
I'm
fine.
going to the bathroom every 2 mintes, so I may have to go during this episode here, but
Right, you're getting your steps in.
right. Yeah. How you doing?
I'm good.
Yeah.
The sun's out. Just, hanging in there.
I know, right? Yeah, dude. So congrats once again to you. You're turning that deal from a potential disaster into a success story. So that
That's
was
what we do.
that was very trying and a lot of work on your behalf. It definitely would not have happened.
Well,
For you.
You too, because let me just say, in this market, it's probably super tempting to do a for sale by owner. You're thinking to yourself well, I can save, commissions, blah, blah, blah. Well, let me just tell you a reason why, right? Well, reason number 826, why you need a real estate agent involved. So I was representing these sellers. The buyers had different representation, which is fine. That's how it works. And after a month and a half of us being under contract, which is what we expected, we found out that their big box bank lender dropped them and said they can no longer finance them for the purchase of the property we were under contract on. So, as a real estate agent, my job is to get the transaction sold for my clients, right? At the highest price with the least possible stress. So I said, okay, everyone, let's hold on. You need to talk to Angelo. And Angelo got those buyers pre-approved, through underwriting, appraisals, everything. God, when did you get the clear to close? How many days was it?
Oh, the clear to close was actually on a Thursday or a Friday, and the closing was the following Wednesday, Tuesday or Wednesday. So business days, let's just say 3 to 4 business days before the actual scheduled closing date was, which I'm not gonna lie, that's kind of impressive, even for me.
Yeah.
but
we were able to essentially save this deal, keep my clients under contract, and us closing on time.
And it's not just right, and it's not just that one deal too. I mean, that would have created a domino ripple effect on multiple transactions, which would have been legit catastrophic.
Yeah, because my sellers were also buying a house, and we were doing a double closing that day, which is also pretty standard practices. But when you don't have, real estate agents, lenders that you can rely on to problem solve through situations, that's when you get into trouble. And, my clients being able to lean on us was a game changer. And then I was I told the buyer's agent, I'm you need to reach out to Angelo. You need to have your clients go ahead and start the process with him, because listen, Angelo, if anyone can get this closed on time, it's Angelo. I understand that you might be upset with the bank and want to file a complaint, but that is
right.
That later.
Right. There's no time for that. There's no time for that. Let's just try to get this. Let's just try to resolve this. Right.
Yeah.
That's great.
That's what we do,
But
though.
no, congrats to you on that. I know we solve problems. So I know last week we touched on a couple topics, but this week we were going to talk about something in particular, weren't we, Ashley? We were going to talk about
Yeah.
HELOCs.
Yes.
We were going to talk about the HELOCs, and it's funny because I did my Friday facts on HELOCs as well, and I've had a couple people reach out like, "Oh wow, I didn't know I could do that." I didn't know what a HELOC was. I didn't know that you could do that to put that, attach that to a property and use that money for whatever I wanted, So
Right.
it's a really, really great tool. So if anybody, it's just, I personally, I mean, I am not only a fan of HELOCs because for personal reasons, I have them just kind of sitting on in standby, and we can go over all the great benefits of a HELOC. So, and I don't even do HELOCs, so I'm not doing that because I want to try to get
Right.
HELOC business. But it's a have kind of in your back pocket. Am I cutting up on you? It's like pausing
So,
sometimes.
yeah, you are cutting up a little bit. We got a bad
Okay,
connection
is that
or
better?
something. Yes.
Okay, cool. You there?
Yeah.
Okay. All right. Yeah, I don't know. It just it was just like spinning. Anyway, so HELOCs. What is I guess your take on a HELOC, Ash? Have you ever worked
Well,
with? Go ahead.
I literally know nothing about it. I just know that like when I go to do a seller net sheet, like when people want to list their house with me, that's like one of the questions I ask, is do you have a HELOC in loop as well as like your primary mortgage,
Yep.
right? And if so, like what is the balance on that, or what is the state of it? Beyond that, your girl knows nothing.
All right. Well, you girls, I'm gonna school my girl. Okay.
Yes, let's do
So,
it.
and a lot of people, there's really no reason to know about HELOCs unless you kind of you start looking into ways to access equity from your home. Okay. So a lot of times going through a purchase of a property too, Ashley, you don't normally see a HELOC when you're purchasing a property. You don't normally
Right.
do a first mortgage and a second mortgage. They're done, but it's not very commonplace. It's usually to kind of like bridge the gap of a difference between a conventional loan and a jumbo loan if there's a small gap or whatever. But so I'll just go. We'll just talk about HELOCs, just why you should have them, and kind of some pros and cons of what you can do with them. So a HELOC is a home equity line of credit. Okay,
Okay.
that is it can be in first lien position if you do not have a mortgage on your property, right? It's usually in second lien position if you don't have a home that's paid off. So it's in second lien position. So it takes, the first mortgage takes precedence, and it is a secured line of credit. It's legit. Technically, I'm going to give an analogy here. It is like a credit card
Perfect.
for your home. Legit. It's like a credit card for your
That's a
home.
good analogy.
Right. Because it's revolving. It's a
Okay.
revolving line of credit that you can draw off of, pay down, and then draw off of it again if you want. So so you're getting better interest rates than credit cards, okay? Better
Okay.
interest rates because it's secured, so they can come after it instead of a credit card. They can't come after shit,
Right.
So
It's not right. It's not affixed to like an
it's
asset.
fixed to nothing. A
Right.
credit card's unsecured. A line of credit is secured. Okay, so so it has a lower interest rate. Depending on credit scores, probably somewhere. And it's based on the prime rate. Okay, so it's not. You can get a fixed line. You can get a fixed second mortgage but that's fixed. So you actually have to draw all of that money at the time of closing. So if you get a fixed second mortgage for, let's say, $50,000, you have to immediately take it. Okay. Whereas a line of credit that's exactly it. You can take it as you need to. You don't have to take it at closing. Okay. And you can use that line of credit for, you can buy a car with it. You can send your kids to college. You can use it for whatever you want. Home improvements, purchasing a car, paying off, student loans, doing an addition on a property, anything that you need, of course, within the limits of the line, you can use that for. It's your money. You have access to it. If you draw off of it, you pay it down. And then if you want to draw off of it again 5 years later, you can draw off of it. Now, usually it's like, depending on which bank you go with or, lender, I'll just kind of give some generals here. So it's usually like a 10-year draw and a 10-year repay. So you can draw off of it for 10. Like I said, don't hold me to, like, because certain banks have, different guidelines. Some are 15 years, some are 10 years, you know what I'm saying? So you can kind of, talk to your particular bank about that.
I have a question really quick.
Yeah,
where should you get this? Like, should you go to your banking institution?
I would most likely go to the best place for it is going to be most likely your local community bank. You can get it at the big box banks. You can get it there. I'm just, so it's basically going to be your banking institutions, your depository institutions. But for me personally, I like using local companies, local banks. And so for me personally, somebody in that footprint is going to have better, better products because they're in that footprint, you know what I'm saying, of your location. Correct. WS Inspect credit unions. So credit unions, and your like local community banks are going to be, the ones to give out those lines of credit. Now there's kind of guidelines that come into place. So how we talk sometimes actually about loan to value, like what are you putting for down payment or whatever. So there's some many banks, they have a cap on how much they'll give you. So they'll cap it. They'll say, okay, we can't give you, with the maximum line of credit we can give you is up to 90% CLTV, combined loan to value. So it's with the first mortgage plus the second mortgage together. What is that total versus the appraised value? Okay. So I know of one, and I'm pretty sure they still do it. It's a Legacy Federal Credit Union. They are located in, I think it's Hickory or High Point. They do 100%. From last I heard, I haven't talked to them lately or spoke to anybody, but they were doing 100% lines of credit, which is like unheard of.
Is that a good idea?
What's that?
Is that a good idea? Do you think, in your opinion?
You're going to be there forever? Why not? And like I said, you don't have to use it. So you're paying nothing. You know what I'm saying? You pay absolutely nothing off of that if you don't want to use it. And so here's a really important fact that, people don't understand. So yes, they want to pay their mortgage down. They don't want to have a mortgage payment. They're trying to get their house paid off, whatever, to get themselves out of debt. Completely understand that, right? Let's say you have a $300,000 house and you have $100,000 left on the mortgage. All right, so you have a ton of equity, and let's say you only have, I'm just throwing stuff out here. You don't have a ton of money in savings. You've been paying stuff off, whatever. Your money's tied up in investments like 401ks, things like that, whatever. You don't have a lot of cash. Let's say you lose your job. And you go to your bank and you say, like to me, for instance, or your bank, and say, hey, Mr. CLT mortgage guy, I lost my job. I don't have a ton of cash. I need to tap into some of that equity from my house because I know I have I have $200,000 of equity in there. Do you know what I'm going to tell you with no job? No.
Right.
I can't help you. Cannot
So you
help
have
you.
to show employment. It's like you have to meet those criteria basically that you would for.
Correct. Right.
Okay.
You have to, for a line of, to get that line of credit, or to get a cash out refinance, or to pull money out, if you don't already have it in place, you're screwed. That's why it's always good to have it when things are good. When things are good, you know, you have equity in the house, just put it on there, whether it's 10, 15, 30, you know, $50,000. If you have the capacity to get that much, just get it. Why not? You know, what if something happens and, you know, an accident and you don't have insurance, whatever the case may be. It is like extremely important. Like, you know, because we're both self-employed. For me personally, I have a line of credit because that's my safety net. Something happens to me, something happens to the business, whatever it may be. You know what I'm saying? If I go broke by, you know, which, you know, will hopefully will never ever happen, then I won't have to use it. But it's there. It's there if I need to. I don't have to then reapply if I want to use it. It's already there.
Oh.
Do you see what I'm
So
saying?
yeah, you apply once, like when you're employed,
Yep.
when you like the home values are
Yep.
essentially at the top because it's going to show you have a lot of equity,
Yep.
and then you get approved for it, you attach it to the house,
Yep.
and
You
you
just
don't
keep it.
necessarily have to use it,
Nope.
but it's there if you need it.
It's there if you need it. It's
And
sitting
it
there.
costs nothing.
It costs zero at that point. And it's doing getting a line of credit from your bank is very minimal cost wise as well. Maybe depending, and a lot of times banks have like programs where it's a no closing cost feature where they pay for the appraisal and it's like $100 or a couple $100, no more than like $1,000 to get a line of credit. It's, you know, of course, or they make it work the end of the line, or you can pay whatever, but a lot of them are no closing costs. So very useful tool to do many. I mean, and another useful tool, let's say if, you know, you have a $200,000, a $300,000 house, you have a $100,000 home, and you want to get 100,000 out just to have it sitting there, and you see a property down the road that like, I'm going to buy that property, but I don't have all the cash, but I'm going to get financing for some, and I can use 50 for my line of credit and then get a loan for the rest. So you can use your line of credit to purchase a house as well.
Interesting.
You just have to include that in the debt to income ratio when you're purchasing a new house.
Okay. What are there any pitfalls that people need to watch out for with, like, what are some negatives to this? Like,
I don't see that there's any negatives to it. I mean, it is variable rate, so it's risky, but here's how it varies, okay? It's variable rate based on prime. The prime rate only adjusts when the FOMC, which is Federal Open Market Committee, meets, and they meet about 8 times a year. And it's going to be based, and so the FOMC adjusts the Fed funds rate, which in the last 2 years has been like next to nothing. So, and if it does go up, it's only going to, or it does go up or down, it only adjusts up like maybe 0.25% every few months. So it fluctuates, but it's not volatile. Okay.
so and is there like, are there guidelines saying like it can't jump up X amount, or
It's not an adjustable rate mortgage. It's prime based. It's based on prime.
Okay.
So, and it's like prime has never gone from 0.25% to 5% ever.
Okay,
in one adjustment. Never ever has it done that. So so it's, and you know, of course like I said, it's based on prime. So let's say, you know, it's prime plus, depending on your credit score, to be prime plus 0.25%, or prime plus minus 0.25% is how they're going to base your rate when you use it. Okay. Now, what we're talking about, I think I just lost my train of thought.
Cons for, like, what are some things you should watch out for if you do this?
When you use a line of credit, the only payment that is required until it goes into the repayment period is interest only. You can make way more than just that interest payment. You can pay 10 times what that payment is. You can, like, say if you have a $50,000 line of credit and you have 50,000 out on it and your interest payment's $250, you can make $1,000, but the minimum required is 250 or whatever. I'm just basing generals here, just throwing numbers out here. And so when you get your statement, you say, oh, you're making your payment. You have to just understand that is an interest only payment, because that's just how lines of credit work. Okay, so you want to make over the payment to pay it down.
Okay, so when they send you like your bill, it's going to be interest only.
Correct.
And you have to remember that they are not actually paying down that line of credit. You have to pay over what they're stating. Okay.
Yep.
So bills are interest only, and that is like the standard bill is only going to be interest only.
Correct. Now, of course, don't hold me to that for every single bank. That there's probably some banks out there that have it may say give 2 payment options. Here's the interest. Here's a payment plus interest, whatever. But normally, it's basically you're going to see the interest, the amount, on your billing statement. It's normally going to be just the interest payment.
Okay. So you just make sure that you are aware of that. If you do use it, which you should, whoever you're paying over that bill.
Whoever, definitely talking to a experienced, educated bank officer to go over all of the details of that. Now, I have, a couple people that I kind of refer business to when it comes to lines of credit. But so, if you want any referrals, I'd be more than happy to send you that. I'm not going to just kind of name drop right now until somebody wants something. But yeah, I mean, I can refer out to some different banks, because each bank is a little bit different, just like me, when it comes to lines of credit. So
now something that just being that mindset, I still have PTSD from like the recession, the housing crisis and all that. So to me, when I'm hearing you say this, like I naturally just feel a little bit anxious about it, because like I don't want people to like automatically pull the max that they can on this. You know what I mean? And then like say housing prices level, right? Which, this is the rates that we're going at right now, like is not sustainable. So like, are you picking up what I'm laying down?
Yeah. So, I mean, like I said, there's one bank that, and honestly, I don't even know if they're still doing it, but they were doing 100% combined loan to value. The majority of your banks are doing 90% max. So they're leaving themselves 10% equity in there for a cushion. So I wouldn't worry about that.
Okay. I mean, and the other thing is like, I always thought, right, this is like, just, how you get those like just preconceived notions in your head of like how things should be. This is one of them for me. Like, so here we go. If you are going to pull money out of your house, like, and get a line of credit, like we're talking about, should you don't like the fact that people aren't going to spend it improving that asset, it seems odd to me, but you're telling me that it's not.
No.
Okay.
If it needs improvement, use it to improve the house, and you'll get some more value.
Okay.
But if the equity is there, instead of paying, I'm just spitballing, sometimes if you want to buy a car, okay, and the best rate you can get is 5.5% on a used car or something, whatever. If you have a line of credit that's based on like 3.5 or 4, it's better than, buying a car. And then guess what? You can write the interest off. You can't write the interest off on a car. Bingo.
Oh, that's a big pro.
I am dropping all sorts of HELOC knowledge on you today, aren't I, girl?
Yeah, pro. You can write off the interest. I'm taking notes right now.
And I'm about to drop another nugget, a really good nugget of knowledge here on you. Which this isn't it's good, It's good. It's good. It's a new product that I know that one of my banks that I have uses, and it's phenomenal. It's called a HIL,
Hill.
HIL,
Okay.
and that stands for Home Improvement Loan.
Ooh, I like.
Boom. Minimum
Okay.
700 credit score, 30 to 50,000. You basically have to say that you are going to use that for improvements to the home. No appraisal required.
Ooh.
Yeah, yeah. I mean, when I saw that come across my desk from my bank referral partner, I was like,
Hello.
that was my face. Yeah, because it was dope. Yeah, that's
So
strong.
that you said a minimum of a 700
700
credit
credit
score.
score.
Okay. So we're gonna chat about this after because I feel like we need this. Like, I got plans. Like, let's do a sunroom or something.
Right, right. Yeah, and it's a
Um,
minimum. I think it's 7 to 8 year loan maximum or something like that. So there's some stipulation, and I can send you the qualification sheet on it so you can kind of see it. But yeah, it is. If that's if you're looking to do some renovations and you're not looking to go, I think it's a $50,000 cap on that. But like I said, I have to double check on that. Um, it's it's pretty strong. It's a quick process from what she's saying and all that. So
so
it's something that people to consider if they're trying to do like a little project and they don't want to.
yeah. So the benefit to get this hill as opposed big. So maybe you're saying like get the hill and the HELOC.
So the hill is actually not even attached to the house, which is crazy,
Oh.
and it's very good interest rates, just slightly over what an actual HELOC is. So it's kind of mind blowing. Yeah, I know, just crazy. It's
So
nuts.
so should so like okay, say that I do want to. Okay, here's an example. I want to do a sunroom. Okay, the
Okay.
sunroom costs $45,000. What product would you recommend?
If
Say I have credit score is not an issue. There's $100,000 plus in equity.
I'll give you the answer. A hill is only for home renovations on your primary residence, and you have to write a statement saying that. A HELOC, you can use that money for whatever the freaking hell you like. So I would say if you are needing $50,000 or whatever, if you want to use some of that 50 to purchase a car, or some of that 50 to pay off debt, or some of that whatever, so to improve your home, that's more versatile is a HELOC. A hill is only for rent, and you legit have to write a statement saying that you're going to be using that for your primary residence to renovate the property.
Yeah. And I'm
So
sure there's like some pretty steep penalties, like if you don't follow their directions.
I would think so. Yeah, I would think so. But I mean, why not take advantage of it if, like no appraisal necessary, and it's a much easier process and this is very new to the bank that reached out to me about it, because I've worked with her over the years with just HELOCs, because I refer her a bunch of my business because I think that she's the best at it, just her service wise too.
I mean, I think that, like, especially because a lot of the inventory I'm seeing out there, like, needs some work, right? Like, this isn't like HGTV ready to go, like, I'm not like Chip and Joanna Gaines. I can't do
Yeah.
those things.
And you know what? You actually so it's funny you say that. I have a client in Wadesboro, something above Greensboro, whatever. She's like, hey, I like this house, but it needs some work. Can we factor in some costs into the purchase? And I'm like, that's a different loan. It's a renovation loan. It's harder to get, because we've talked about renovation loans. You got to do a lot of, you have to get a plans and specs ready and blah, blah, blah,
Right. Yeah.
contractors. So if it's not, if you have the score, what I would do, well, I told her, I said, all right, I wouldn't do the renovation loan because you're probably not going to get it in this market because it's a longer process. You know what I'm saying?
Yeah.
And B, it's it's going to be a little bit higher interest rate. There's going to be more costs and fees associated. So if you don't need $100,000 to fix the property up, you know, or not like a complete renovation, then just get the home equity loan after the fact. Get everything set up with your lender, like the bank that you're going to work with. Say, hey, this is what I'm doing. I'm going to buy this house, and as soon as you close, then get that close on the home equity loan, or a home improvement loan. I'm sorry.
Oh, the home improvement loan.
Yeah.
Are they going to give you money based on the after improvement value, or what's that called?
Not for the home improvement, not for the HIL loan. It's not. They don't do an appraisal.
Oh.
They only give you a maximum, like they cap it, so you can't get over a certain amount. So yeah.
But they're not gonna do an appraisal no matter what. So
or like a legit renovation loan, you have to get the full appraisal process and do it right. This HIL loan is just it's not, none of that.
See, that's good.
I've never thought about that. That could be, you know, when you're showing homes or talking to people, if it needs, it's, you know, $5,000 to $8,000 that they don't want to, you know, they say, hey, this is a product. Talk to this person, see if you can get that in place, and then boom, boom, boom.
I mean, like,
instead of going through the whole process of trying to get a whole renovation loan and get the plans and specs and contractors out and all that shit, you know. I can send you the details on it. Yeah. So I'll send you the details when we get off the call.
And I'll put that in my stories and stuff too, because I think like we have a client right now that I feel like could use it.
Send it to him. Tell him about it.
Like, we're getting ready to close. There's some things that are like coming down the pike that he knows that he's going to need to do. I feel like, hello.
Right.
Now all of a sudden we become Chip and Joanna gangs. Bam. That's how good we are.
Yeah, I'll send it to you. And it's, you know, like I said, it's new. I'll send it to you, and I'll even put you in I'll put you on a thread with the actual banker that sent it to me, so you can kind of reach out to her when you need it for certain clients, you know, if you have.
And so she can do HELOC and this hill.
Correct.
Winning. That's what we do.
That's right.
That is what we do. See, these are the benefits of like watching our Tuesday talks, because you're going to be like, wow, I can go buy a car or like put a screened-in porch on my house. Yeah.
Or you can pay for one semester of highfalutin college for like $50,000, you know, whatever.
Right. Yeah. Whatever strikes your fancy.
Whatever floats your boat.
Yeah. Oh my God. Okay.
I knew that would be a good topic. Yeah. I know when we kind of mentioned it last week, and then the kind of response that I got from people reaching out about that, I was like, this is going to be a good one. Not many people know. Not many people know.
I mean, like, Angelo, I literally had no idea. Like, I had no idea. And so tonight, James and I are going to be talking about doing this. It's all rolling.
Right.
And I hope if y'all tuned in that you do the same, and make sure you reach out to myself and or Angelo, specifically probably Angelo, if you have questions on this and want a referral on where to get this. I always like to say, reach out to Angelo, like for his like go-to people for, you know, the banking and money world of things, because you never know. And we want to give you value, and he's got lots of it when it comes to this. So.
Oh, thanks, Ash.
Yeah, this was really good. This was really, really helpful. Now I'm like a little bit nervous about like doing my recap, because I'm like, oh my God, I'm going to like mess up some of these things.
You'll be fine. You'll be fine. And remember, people need to follow us on our Tuesday Talks YouTube channel. All the Tuesday Talks are uploaded out in that channel now. Every single one of them. Like us, share us, follow us, tell all your friends about us. And anything else? I think that was a good one.
That was a really good one. If y'all have a topic that you want us to cover, make sure to drop us a line, a comment, email, DM, send a flare in the sky. I mean,
Right.
not sure we'll get the
Carrier
flare,
pigeon.
but
We'll
yeah,
figure it out.
yeah. Thanks so much for tuning in, and this was great, Angela. Thank you.
You got it. Talk to you soon.
See
Bye-bye.
y'all next week. Bye.